Our first guest sees trying times ahead and figures the best antidotes, yield and yield growth. Joining us from the TSX Broadcast Center, Diana Avigdor, Vice President and Portfolio Manager and Head of Trading at Barometer Capital. Good to have you with us again, Diana.
Hi, thank you very much for having me.
We're seeing low volume here on the upside, and when we see a negative day, we've got strong volume as well. What does this sell-on weakness scenario tell you?
It feels a bit like the pain trade is higher as people are starting to realize that the Italian elections are not derailing this rally. We do have RSP season coming to an end, so I'm very curious to see what's going to happen in the markets the first week or two. That being said, what I meant trying times ahead is not that we're not bullish on the markets, we are, but what we're saying is that what traditional beta that's worked in the past, the defensives are the new beta. In other words, you're getting the same return by going into large cap, yielding, yield growth, and some capital appreciation as you would have in the past if you went into small caps.
So with that said and done, what about that idea of a great rotation out of bonds, because that play is done, and into stocks broadly speaking? Is that going to underpin your general bullishness?
You know, actually we have not seen the rotation out of bonds into equities. What we have seen is new money coming into the market because we have not seen cash flows coming out of bonds as of yet. We do see the yields fluctuating back and forth. I do think that being in bonds, government bonds, may be a little bit riskier than most people that tend to buy into bond funds. So maybe you decrease your weight a little bit. But we've seen new money coming into the market, not so much the great rotation as the great retail comeback, perhaps.
How much more upside can you expect, though, in yield-oriented equities if that play is getting so crowded?
You know, it's a revaluation of things. It's equities that maybe historically have not paid the yield that you're expecting them to. It's the U.S. financials that are normalizing their earnings, and you're expecting them to be able to pay back a higher form of dividend or higher share buybacks. It's in the Canadian financials that you're seeing, even in the one financial that yield increase was not expected, like BMO yesterday, you saw a dividend increase. So you're starting to see that as a theme. You're starting to see it in other sectors that have not traditionally paid out a yield or a dividend, trying to attract the investor base by paying some back. And also, you know, you have a lower growth environment with low rates. It's entirely possible to do that and still grow.
Tell me about the small cap space here as we sort of shift gears for a moment. We're not seeing them make new highs, are we?
No, we're not, and that shows that supports the theme that you're getting the same return by going into the more stable large cap dividend payers and dividend growers as you would have with a more traditionally speculative beta sector such as the small cap. Large caps have outperformed small caps by about 3% this month. You're seeing new highs on CP. You're seeing new highs on the telcos. You're seeing new highs on Bank of Nova Scotia. Those are very big companies making new highs.
Well, you mentioned CP, and let's look at CP specifically because it's an influential issue today as well. But while it does have a dividend, a modest one of 1.25%, does it really fall into the camp of yield growth? Do we really see that iron horse making a play to boost its output from the 35 cents it's currently giving us?
That is in the yield space would be on the low end. That is a crude by rail story, really, and an economic growth story.
Mm-hmm. So,
but there is no. The stock is still paying something. You're not seeing these companies not giving anything back to their shareholders.
So within the telecommunications space, where we often talk about those as the widows and orphans stocks, where do you see value and where do you see growth?
Well, we're seeing it best in TELUS. It's the most underlevered of the three telcos, and while all three of them are making new highs or close to new highs, we feel that TELUS is most in position to increase their dividend growth and do share buybacks.
Yeah, we got that increase from 64 cents to 68 cents already. At least that was announced. How frequently do you expect TELUS to continue to open its wallet wider?
We don't make those kind of predictions, so going forward in the next year or two.
Okay, so you would be willing to make a buy on TELUS on expectations of
continued growth, continued business growth, continued increase in dividend.
Mm-hmm. And just to play devil's advocate, and of course to make sure that my bills get paid, tell me about the parent of Business News Network through its Bell Media division. BCE does have a stated dividend growth policy, whereas others have been a little more shy on that front. Why is BCE not your go-to play?
I have to pick, well, because it already has that dividend yield much higher, and the growth rate perhaps similar but not as high, and I have to pick the best one for my one pick, and so I chose.
We appreciate your insight as always, Diana. Thank you so much.
Thank you very much.
Diana Avigdor, Vice President and Portfolio Manager and Head of Trading at Barometer Capital.